Saudi Aramco have cut oil prices, which has left the market feeling bearish in the short term. We can see companies like Chevron, companies like ExxonMobil down up to 4% today. And whilst they have started to recover, it does look like both Chevron and ExxonMobil seem to be very undervalued. They are both trading towards their 52-week lows, as we can see here, not far off at all. And we're going to run through both of these companies, looking at their financial metrics to understand whether or not these are deep value companies, strong buy nows. We're going to run them both into our valuation model, getting to the intrinsic value, the acceptable buy price given our investor margin of safety, and finding out what Wall Street expects from these companies over the next 12 months. And a quick spoiler alert, both of these companies are significantly undervalued. So let's jump in straight away to Chevron Corporation. Now we can see over the last week it is down around 1%. It has started to pick up. It is down nearly 2% today. Trading towards the 52-week low, it does offer a yield of around 4%. And the forward PE currently sits at 11.33. Now, if you've been holding this over the last 10 years, you would be up only really 24%, bearing in mind that doesn't include dividends reinvested. And we can see at the back end of 2022, its all-time high at around $185. Now, dividend safety, 90, it is very safe. Market cap, 283 billion. We're talking about a mega cap company. In terms of those recessionary metrics, well, they increased the dividend during the last recession. Below average growth, negative 43% versus the S&P average of negative 12%. And they also outperformed the S&P, negative 34% return versus the S&P's negative 55% recession return. Dividend growth, very nice to see, 6.3% in January 23, so we are expecting an increase this month. And remember, that is above the 4% we advocate on the channel to keep up in line with inflation. Last 5 years, it's 6% positive as well. Last 20 years, 7% on average year on year. They are a dividend aristocrat. They have been increasing those dividends for the last 25 years or more. And we can see they have been paying dividends for the last 111 years without a reduction. So dividend yield theory, as always, states a company is undervalued when the current yield sits above the 5-year average. 4.08 for Chevron versus the 5-year average of 4.04. So we have a sign of reasonable valuation, bearing in mind we're not looking at any of these models in isolation, and we'll draw conclusions towards the end. Forward PE, a sign of undervaluation, 11.2, sitting below that 5-year average of 12.8. And in comparison to the energy sector PE, Chevron sits lower at 11.2 versus energy's 12.4. As always, we do focus on the free cash flow payout. Earnings is susceptible to manipulation by management through accounting. Personally, below 60% is my preference. You can bring it down to 40% if you want to be industry specific for oil producers. But essentially, these percentages give me faith that management can offer double-digit dividend increases where possible. 2021, 2022 below 60%, 2023 expected 55%, so that is positive to see, and I am expecting a very nice increase to Chevron's dividend this month. Free cash flow per share, negative 156 in 2013, 1950 in 2022, expected to be lower in 2023, but this is typical of the industry, which is volatile and cyclical, so this is to be expected. And as always, do understand the type of companies you invest in, as we can see here on the top line. Negative growth for 4 years, followed by double-digit increases to the top line in 17 and 18, and again the cycle repeats, and we can see that here based on the total sales numerically. Shares outstanding, they've diluted your position as a shareholder over the last 10 years, but they've also bought shares back. The net position over the last 10-year period is they have increased those shares outstanding by around 10 million. So let's take a look at the ROIC. 10% or more is my personal preference. It gives me faith that management are able to effectively allocate their capital. 2022, 21%, very nice to see. 2023, it is dropping lower, but still positive in my opinion at 15%. Margins, again, typical of the industry. We do see, however, the last few years looking positive above that 12% that we look for as a minimum. Free cash flow margin, a very similar story. Double digits over the last 2 years. 2023 expected 10% above that 5% minimum. So in terms of the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, remember this shows us the balance sheet strength as well as dividend safety. 2022, 0.17, showing us the number of years it would take the company to pay off all of their debt net of cash on hand. 2023, slightly higher, but this does show us this company has a great balance sheet as well as a very safe dividend. So let's jump into the valuation for Chevron, and those regular viewers know for those deep dives we run through every single essential valuation, but for today's episode we're getting straight into the valuation intrinsic, and this is essentially the average of these four models coming to $180.57. So with the current trading price for Chevron, we start off with a margin of safety of 10% if we believe it has a wide moat, strong financial metrics and good forward-looking data. We can see it is a buy up to 163, 15% up to 153, 20% we can see it isn't just there yet. So right now for Chevron we see around 15 to 20% margin of safety, and as always this does really depend on your own investment thesis as to what level of margin of safety you are happy with. What do Wall Street say? Well, we can see they expect around $180 per share over the next 12 months, so they do see some nice upside at around 15%. So in conclusion, for Chevron stock, we see around 15% margin of safety to 20%, with Wall Street expecting 15% upside over the next 12 months. When we move on to ExxonMobil, we can see it is down nearly 3% today, around 2% over the last week, and we can see that 52-week low not far at all from the current trading price. It offers a yield of 3.7% and a forward PE of 11.1. Now again, if you've been holding this over the last 10 years, you would be pretty much flat on your investment, and we can see the all-time high was towards the back end of 2023 at $120, around 20% from the current trading price. So let's take a look. Dividend safety, it is 80, it is safe, bearing in mind that Chevron was 90. Market cap $410 billion, a mega cap company. Now, recessionary metrics, we can see they increased the dividend. They had below average growth, but they outperformed the S&P with a negative 28% return. Dividend growth 4.4%, so just in line with that inflation that we always advocate. 3% over the last 5 years, 7% over the last 20 years. Now, they are 10 years away from becoming a dividend king, so they are currently a dividend aristocrat. And they've been paying dividends for the last 141 years without a reduction, a phenomenal metric there. And in terms of dividend yield theory, we can see a sign of overvaluation, 3.8 sitting below the 5-year average of 4.72, with a sign on the forward P of undervaluation sitting below. And this is why we always say we don't draw any conclusions just yet. We wait till the end, where we do also incorporate the value of the current price. So sector PE, we do also see ExxonMobil 11.6 below the sector PE of 12.4. So in terms of the free cash flow payout, last 2 years very positive, below 60%. 2023 expected to be 39%, so we should expect a decent increase to the dividend this year. Free cash flow per share, essentially more consistent than the previous company that we just went through, Chevron Corporation, where we have only 1 year of negative free cash flow. 254 in 2013, 1390 in 2022, although do note it is expected to drop in 2023. Sales growth, again, the essential cyclicality of the industry, so this is something that we should be aware of when investing in companies, and that is shown here on the total sales. But we can see in terms of shares outstanding, the net position is they have bought shares, they have returned excess cash to investor pockets, so that is a positive sign from ExxonMobil. In terms of the ROIC, again positive, the last 2 years above that 10% we look for, and 2023 expected to be the same at 19%. But as always, we will wait until that annual report and quarterly report comes out. So if you are interested, do click on that subscribe and bell button so you are notified, and we will run through that when it is released. Operating margin, we do see again fairly positive over the more recent period over the last 3 years, and the same can be said for the free cash flow margin, but as always it is just due to the cyclicality nature of the oil and gas industry. Net debt to EBITDA, very similar to Chevron Corporation, 0.2 in 2022, expected slightly low in 2023, a phenomenal balance sheet, and the dividend remains to be safe today. So let's take a look at the valuation, and as always, click on that pinned comment below where you can pick up a copy of the valuation model, getting to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list. So let's jump straight in. Margin of safety of 10%. It is a buy up to $117. At 15%, 110, and at 20%, 103. So we can see if we move it 25, it's not quite there yet. So whilst Chevron Corporation had between 15 to 20% margin of safety, we see that ExxonMobil, in fact, has a larger margin of safety of between 20 to 25%. So what do Wall Street say? Well, they see around $129 over the next 12-month period. So, in fact, ExxonMobil seems to be significantly undervalued, not just in comparison to Chevron, but just in general to the market. Currently, the margin of safety is around 20 to 25%, with Wall Street expecting 30% upside. In comparison to Chevron Corporation, as we just ran through, we're looking for around 15 to 20% margin of safety, with Wall Street expecting around 15% upside. As always, though, do let me know your thoughts in the comments below. Have you been adding any of these oil giants over the last dip, over the last few days? And if you do, let me know in the comments below any reasons why you are continually bearish on this industry. As always, smash that like button if you've enjoyed the content. Hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to grab a copy of the valuation model and catch you all in the next episode. Take care and have a great day.